Alhamdulillah, Rabbil Alameen. So, Alhamdulillah, so today, inshallah, we will start our second session on the basic accounting. Then our other two sessions, inshallah, we'll be doing our practice on the weekend, bi'idhnillah ta'ala. So, in our first session, so I know I forgot to share the link for the recording and the notes, but I'll share that. But the link, it's the same website that we have the Islamic study. So what I will do, it's the same YouTube channel. So I will share the link, inshallah, afterwards to the channel, just in case persons need a shortcut. And then you'll find both recordings there, bidnillah. So alhamdulillah. Um, the first set of slides we look at had to do with basic accounting. We're going to look at some different notes, inshallah ta'ala, on accounting itself. Now, these notes will carry us a little further. I'm not sure if you all got a chance to watch the videos. If you haven't, you should still watch them. It would give you more clarity on this issue. There is actually probably just two more short videos from the same channel that I shared this from that I will share with you in terms of understanding the basics of accounting. And as I said, from this particular course, the four sessions that we are going to do, inshallah, you will have a good grasp of what the basics of accounting are, just reinforced by watching the videos and then going through the notes bidnillah. The other sessions we'll be doing a couple practice questions just to ensure that we understand what we're doing bidnillah ta'ala. All right, so let's begin. We mentioned what the main objective of accounting is, and it has to do with basically keeping a record of what business do. That's pretty much what accounting is. So that's necessary. Because one of the main objectives people have business for, one of the main objectives people work, one of the main objectives that people try to earn is to make money, right? So a business only makes money when it's making profits. Because if it's not making profit, that means it owes people money, it's making losses, and then after a while, just we all you're doing is losing. Nobody wants to lose money. People want to gain money. Right? So in order to assess that, you need to have, so that's what accounting is. Accounting is keeping a complete and systematic record of all the transactions of a business during a period. So that's what it is. The first person that they attributed accounting to, not necessarily, I mean, in terms of the concept, the systematic concept is Luca Pacioli. He is the one that is actually considered to be the father of accounting. But we know, as we say, that accounting has been done from day one, but maybe not in the format with debits and credits as we know it today. So that's what I said. So the main thing, accounting really is identifying, recording, classifying, summarizing, interpreting, and communicating financial information so people can make decision with it. So it's a way of, okay, know what the expense, identifying pretty much means that here, this invoice, I know it has to do with the business. This cash memo, it has to do with the business. This bank statement, it has to do with the business. You have to identify that all of these relate to the business. Recording now, as I say, is keeping a systematic record. So you want to have all your bank statements pretty much in order. You don't want to miss several months. I don't know what I did in January, but I know what I did in February. I don't know what I did in March, but I know what I did in April. No, so recording pretty much is having a systematic record of all the transactions, having all the invoices, everything in their complete state. So you sold 25 customers, you did 25 invoices. You want to ensure that you recorded all 25 sales transactions. The third thing is what they say, classifying. Now, classifying basically is grouping the transactions that are similar in one place. For example, all your sales invoices you want one place. Your light bill, for example, you want to put one place, right? Your rent, you want to have that one place. So you're able to know what relates to what. Okay. The next one is what you call summarizing. So summarizing now basically is, okay, I want to know what my rent is for the whole year. I want to know what my sales is for the whole year. I want to know what my insurance is for the whole year. So that is summarizing. So you don't want to be able to have to go add up all the sales invoice one by one to know what the sales is. You want to have an idea how much did I sell for January? Even though I did 200 invoices, what was the sales in January? What was the total amount? So that is summarizing it. So one line, you know what the sales was for the month, what was the rent for the month, what was the insurance for the month. The other now, analyzing. So now analyzing now is putting things in the right place so that now you can differentiate that I know this has to do with my profit, but this has to do with my assets. So that has to do with my balance sheet. Like what we said from our first session. In our first session, we said that for a balance sheet, what goes there is our assets, our liability, and our equity, our capital. And we said that for our income statement, to see if we're making money, is our revenue and our expenses go there. So analyzing is making sure things go in the right place, right? This is going to the right in the right document. This is in the right report. Interpreting now is seeing whether or not, basically, this is now whether or not you want to say, all right, is my sales getting higher? Am I spending more on rent? Am I spending more on salaries? That's why you want to interpret the information of, because you want it to be able that people can make decisions with it, right? And communicating, when you have everything all put together, people are now able to make decisions with it. So that basically is what accounting is. So all those 7 words pretty much is saying. So for the first one, let me make sure everything that relates to the business, I have it. All the documents that relate to the business, I have it. So identify it. Secondly, let me know, record it, right? So let me know, make sure I have all of them and nothing is missing. Third one, let me put them in the right place. So, okay, this is rent invoice, this is insurance invoice. Summarizing now, you want to have a total. So now you know you have all the insurance invoice one place. What was the total insurance amount? So summarize it, have one line for each of them. Analyzing now basically is to ensure that each thing goes the right place. So this is to the income statement, this is to the balance sheet. Interpreting, basically now you're able to make decision that, hey, my sales increase more over the month, my salaries go down for the last 3 months, things like that. And then communicating, you have it in a report that people can now see it and understand how the business is doing. Right? So now another thing that they mentioned, and we're not going to go through this. So some of the things they don't necessarily need to go through in detail, unless you're going to go do detailed accounting. So some of them we're really looking at the most important things. So the accounting cycle basically is just showing the process how everything happens. So all of that 7 points we said earlier, they call it a cycle. You have the transaction, you do your journal, your ledger, it goes in a report, and then you end up in your financial statements, right? But that basically just showing you the process of how it usually occurs. As I said, it's not everything we're going to do detail like that. Transactions, journals, we're not going to look at all of those in detail. But basically, sometimes when it's a bookkeeper or accountant, very similar. Bookkeeping, basically, as you know, this is just making sure you have everything put in the right place. The accounting now is where, prepare those reports that people can use that you communicate to them. So the bookkeeping is having everything in the right place. Yeah, identifying it, measuring, recording it, classifying it. Now the accountants summarize it, analyze, and then communicate. I mean, they put it in a set of what you call financial statements. So yes, so this does give a difference. So these notes, yes, you will be able to get these notes as well. Um, what are the objectives? What are the main objectives of accounting? Keeping a systematic record of your transactions. You want to have a record of everything the business does. Calculate whether you make a profit or loss, and to ascertain what's your financial position. And that part means how many assets do I have? How many people do I owe? Right? So you assets and your liabilities. Because you really want to know, um, do I own anything? Does the business own anything, or does the business owe anything? So those are some of the reasons. And another reason is, if somebody give you some money to the business for them, they want to be able to know how the business is doing. So you want to provide information to the people who invest. Also, the government want to know, because the government want to charge you taxes. The bank wants to know how you're doing, because they're not going to lend you money if your business is not doing well, right? The people you want to take credit from, they might want to know how your business is doing, because they're not going to give you credit if your business is not doing well. So those are the main objectives of accounting. Keeping a record of your transactions, trying to know whether or not you're making a profit or loss, looking at whether or not how your assets and liabilities are at a particular point in time, and then giving information to people that want information in order for you to do business with them, and also to pay taxes. You have different types of accounting, right? And for persons who may end up studying other courses, like going doing the ACCA courses or doing the CPA course or other chart accounting designations or degrees, you're going to find out that you have different accounting courses. You have what you call financial accounting. Now, financial accounting basically is the general accounting everybody knows. Your debit, your credit, your assets, your liability, putting everything in record so that you can report it. Cost accounting is a little bit different. Cost accounting now is like you're manufacturing goods, but you need to know how much it costs you to manufacture one item, because it's not just that you buy something and sell it back, right? You buy the flour, then you bake it, so you have to utilize electricity, then you have to pay somebody to bake it. So all of those things you have to take into consideration. So how much does it cost me to make a loaf of bread? It's not just the flour and the salt and the yeast and whatever. Yeah, it's not just the ingredients alone, because you're gonna have just using light, right? You're using gas, right? You're paying people. So all of that involved in making the bread, because without the baker, you can't just put all the ingredients beside each other and then tell somebody, if you want bread, here are the ingredients, and sell them for the price of the bread. So that's what cost accounting is. So somebody make a car. Making a car, it takes use a lot of parts from every different place and different costs, and then you have different people making it, the engineer, everybody. So cost accounting has to do with analyzing how much it costs you to make a product. You're manufacturing a product, how much it costs you. You're offering a service, how much it costs you to offer that service, right? So that's what cost accounting has to do. So financial accounting is the one we just talked about, recording everything and preparing your report. But the cost accounting now is being able to ascertain how much each item costs. So before I can sell it, I need to know how much it costs to see if I can make a profit on it. Management accounting basically takes information from both the financial accounting and the cost accounting. So those are the main types of accounting. So you might hear somebody say they have a cost accounting course or a financial accounting course. So yes, they're accounting course, but they look on different aspects, right? So accounting, as you know, is pretty much is an art and a science as well, right? Because you have to look at observation, practice, experiment, innovation. So a lot of the things you see um, in accounting, it is a lot of the things are pretty much scientific with regards to accounting. And getting into it, we will notice that pretty much using a lot of formulas, a lot of calculations, observation, repetition, what works, what doesn't work, how you can improve, and then you see if the system gets better. So all of those things are pretty much a part of accounting. What are the main advantages? It protects your assets. You're able to know whether or how much tax you really need to pay. You don't have to depend on your brain that, you know what, I sold 25 in January now, about 17 in February. You don't have to rely on your brain. You can now compare how the business has been doing over the last 10 years. You're now able to take loans because people say, oh, your business is doing well and you have enough assets. And you can also even sell your business, because now that somebody knows this is a good business, let me buy it, and you can make a profit on selling it because this business has been doing well. So those are some key advantages of accounting. Right now, another thing though, it's you have sometimes this is one of the things we're going to just mention very briefly, is that a lot of the time people try to manipulate their records in order to look good so they can borrow money or so they pay less taxes. Right? Now, that is one thing we know. A very important thing in accounting is what you call ethics, right? It's important, and this is something that we know is the same thing in Islam. In accounting, ethics is extremely important, right? They have the principles. It has to say you have to be honest in your dealings. You call truth and fairness. So you have to ensure that you reflect the right position. You're not deceiving others, right? That whatever you're doing can be trusted, it's accurate, it's complete. You haven't excluded anything, right? And you haven't inserted anything that should not be there. So that's what it means. So window dressing is when people manipulate the financial statements. So when you hear the word window dressing, it means that people manipulate the financial statements. Another thing with accounting is that financial accounting looks on what happened already. How much did you spend? How much did you make? When you hear like management accounting a lot of the time is pretty much looking at, okay, you can now start make budgets. How much do you want to make? How much do you want to sell next month? So that's one of the main difference you can say with financial accounting. Financial accounting look at record, historic record, things that happen already, money that spent already, money that make already. But in management accounting, look at that as well. But it also include how much can I sell this for? How much can I make? How much do I plan to sell next year? Right? So that's also something that we have to pay attention to as well. So okay, so we have different types. So I actually want us to do a little quiz as well. So those are some of the key things there. Some of these words, recapping, just in case we don't remember. We say capital, or the same thing as equity, is basically the amount invested by the owner in the business, right? So we mentioned these are some of the terms that they are known by, right? So capital, so I say, so basically, as we said, capital is also known as equity, also known as net worth, also known as net assets, and it's pretty much the amount that the owner invests in the business. What we say the accounting equation is asset equal liability plus capital or equity. Drawings, I mentioned that as well. Drawings basically is whatever the owner take out of the business to use for themselves. It can be money or it can be the goods, right? So drawings is basically what the owner take out of the business for their personal use. All right. Liability. You know, liability basically is whatever the business owes somebody. So they owe people their salary, they owe people for the goods that they bought, then that is a liability, right? You have different types. You have internal, right, where you probably owe the owner, right? And you have external, where you owe somebody who doesn't own the business, right? Now, liability sometimes they can split even further. They might say what is current and what is non-current. All that means is current mean you have to pay it off within a year. So that's what I mean current, right? Now you have to hurry up pay that off. You don't have long to pay it off. Non-current mean is more than a year. So it's a mortgage, right? 25-year mortgage, right? Or is a car loan, a 7-year car loan. That's basically in terms of how they would speak about classification. But we're not worrying about classifying them, as I said. Well, we know the main thing. We have assets, we have liability, we have capital, also known as equity, we have drawings. The only thing that they don't put in now yet is our revenue and our expenses. The only thing we don't discuss it. So here is a little case, right? It says Mr. X invests 10,000 rupees in his business and he takes a loan of 25,000 rupees from the bank for 10 years. Then he buys goods worth 2,000 from Mr. Y on credit for 2 months, right? So the 10,000 basically you can say is an internal liability or capital or equity, meaning that is the owner or the business owe that money. The 25,000 from the bank is an external liability because the bank don't own a business, right? But you can classify that as non-current. Why? Because it's a loan that is 10 years, right? So, and then current, Mr. Y, let's give you sell you some goods on credit. That's a liability, but you have to pay it off within 2 months, less than a year, right? So that basically is what I mean. So that's just a little illustration to show what I mean by internal liability, external liability, non-current liability, and current liability. All right, so that's it in terms of what's current and what's not current. As I said, I'm going to give some examples of what are assets and liabilities. Now, we didn't look at all the type of examples. So don't worry about the non-current and the current, as I said. We're looking at assets. Some examples of assets. Your furniture, you can own that, yes. Land and building, yes. The cash in the bank account, yes. Computers, yes. But what also patents, right? Goodwill. So patents. So these are not things that you can touch, right? But you pay for the right to have this brand. So you have a brand or you patent your brand and your brand carry a value. right? So those are also assets because they have a value and you own the brand. So they have a value. Other assets, your debtors, mean these are your customers that owe you. Your stock, these are your goods, your inventory. Bills receivable, meaning that, okay, you probably pay some things in advance and people are supposed to give you back, right? If they don't give you the goods, so things like that. So whatever, these are all assets, mean you own these things, right? Now, that's not necessary here. The thing that we said we have is revenue and expense or income and expense. That's what we recap now. Expenses, no. Expenses basically is normally things that go to your profit and loss, right? Expenses, things that you need to spend in order to make the money. For example, you have to pay the rent for the building. You have to pay the security, right? You have to pay your insurance. You have to pay your staff. So all of those are expenses because you have to pay them before you can say you made a profit, right? So these are things you have to pay before you can say you made a profit. So how do you basically get your profit or your loss is revenue minus expense, right? In order to know whether or not you make a profit or a loss, all your revenue mean all your sales, right? Minus your expenses. That's basically how you will determine whether or not you make a profit or a loss. All right. So here are some is a little case to give an example, right? It says the following transactions are reported during an accounting period. Now you sold goods to a customer. That's a sale. Somebody steals some cash from the office, you lose some money there. Now, the 2,000 earned by selling the goods worth 10,000, right? So they said, so there are 10,000 earned by selling goods worth 10,000 for 12,000. Now, what that means is you bought the goods for $10,000, you sell it for $12,000, right? So that's sounds like you make a little profit on the goods, right? Okay. You have a machine, it costs you $25,000, but you sell it for 28,000. Then okay, that's a gain as well because you sell it for more than what it's worth. Now I want us to look on the distinction. This one now, we're gonna look on the distinction between when we buy goods to sell back, that is considered, those are called purchases, right? So whatever we buy to sell back is called purchases. So for example, I am selling coconut. I buy the coconut, right? And then I'm going to sell coconut water with it, right? So when I buy it, it is considered a purchase. So we want to pay attention. We consider it a purchase because you can put it in your purchases expense, right? That you sell it back. Now, if I bought a van to carry the coconut, right? The van is, I'm not selling back the van. The van is an asset. So you're not going to put that in purchases. So that's one thing I'll just repeat again. So yes, you buy it. So some of us will say in accounting, some words are used differently, right? Because we would have said, boy, as long as you buy something, it is a purchase because that is what the word purchase mean. Purchase mean to buy. But in accounting, when somebody say purchases, what they're speaking about is something you buy specifically to sell back for the business, right? Everything else is have a different name. So if you bought a land and building, you're not going to put it in the purchases account. The land and building is an asset, you're going to put it in the asset account. If you bought a van to sell your goods, the van is not going to go in the purchases account. It's going to go in the asset account. But if you bought goods, right, to sell it back, then the goods can go in the purchases account, right? That's the most important difference. From this whole table here, that's the most important thing you should take from that. Now, another thing when it comes to stock, another thing when it comes to stock is that when people say stock or inventory, pretty much mean the same thing. But the only thing is that sometimes you can have different, you can have raw material. Remember I was speaking about a bakery? A bakery, you would say the bread is their inventory, that's their stock, their finished goods, right? You'd say that's their finished goods. You say the bread, all right. But they have flour that they don't use yet, you know. They have sugar that they don't use yet, you know. They have margarine that they don't use yet. That is still their inventory. But that's they're gonna call that raw materials, right? So that is still their inventory, their raw materials. Now another thing is sometimes them have to prep and they have to set make it set and everything their amount to rise and whatever and the month finish. So they do it on the last day and them leave it overnight, but them going to check what they have. So they have to check the raw materials. So they're gonna have to check, okay, I have this amount of flour, 25 bags of flour, that's inventory, but raw material inventory. They're going to check how much bread bacon out there and package out. So all right, that's finished goods. But then they're going to check those that is there to raise or those that is still in the oven and they don't package yet. So those are what you call semi-finished goods. So that's one of the things you have to realize, that you might have different classes of inventory, but at the end of the day, inventory is things you plan to sell. If you don't ready yet to sell, it's still inventory, but you just put it in a different line. It can be in a raw material. This is just a raw material inventory, or this is the semi-finished goods inventory or the work in progress inventory. So that basically is regarding your stock. All right. So I am going to just give you just a few principles here, and then we will spend a few minutes on recapping something with a little online quiz. Nothing too deep or technical. So just give me a second here. Just some words you might hear. When you hear people say GAP, GAAP, all that means is General Accepted Accounting Principle. So now when you see that word, you say, I know that what that means is basically the principles that accountants follow, right? So that's pretty much it. The principles that accountants follow. Right? So that's what that is, the principles that accountants follow. What are some of the main principles accountants follow? What they call separate business entity concept. All this means, you don't have to look at all those words. What that means is, you see, if you own a business, the business money belongs to the business. Not because you own the business, anything in the business, you can just take it, you can use it. Because if you do that, the business, you can run out of business. It's not going to make sense. You're going to actually run out of business, right? So what is very important, a separate business entity mean the business is separate from the owner. That's what the concept is. The business separate from the owner. That's what the business entity concept is. So that's pretty much what it says. The business is separate from the owner. So the assets of the business belongs to the business. And if the owner take anything out of the business, it is considered drawings. Because they pull it out of the business, they're going to have to account for it as drawings. The next one now, the other concept. So one of them, as we said, is separate business entity, mean the business separate from the owner, right? The next one is what you call the money measurement concept, right? So basically, in accounting, money measurement means the only transactions you're really paying attention to is the ones that you can express in terms of money, right? What is the monetary value, right? If you don't have a monetary value, then you don't account for it, right? So the accountant is just accounting for money. You have to can measure it. So okay, yeah, man, the business is nice, that. Okay, what is the value? That's what the accountant considers to be important. The money measurement concept. So the first one, as you say, the separate business entity mean the business separate from the owner. The second one, the money measurement concept. What that means is I'm only concerned with money. So, okay, this is related to the business. What is the dollar value? Does it have a dollar value? Yes, I'm going to record it. It doesn't have a dollar value. I don't care about it. That's pretty much what the money measurement concept is. The next one is what you call the dual aspect concept, right? Or the double entry concept. What that means is every transaction have two aspects. That's what it means. So dual aspect, dual just means two. Every transaction has two aspects. That's simply what it means. Every transaction has two aspects. The going concern concept, you know what that means? That means you hope that the business will last forever, right? So the going concern concept is pretty much saying that you think and you hope that the business is last forever. Mean that you are planning, that you're not planning to run out of business, or you don't think the business is going to close down next week, right? So going concern concept means that you're assuming that the business will continue to operate. You expect that the business is going to continue to operate, right? So basically, and this is what we're saying, so accounting pretty much is what you call the language of business, right? So normally that's one of the definitions that they give, right? So accounting basically is what you call the language of the business. Now, that's the going concern. Accounting period concept. What that means is record the thing when it's supposed to be, no? So if you have taxes for January, put January taxes in January accounts, right? If you have light bill for February and JPS didn't send it to you until March, make sure you account for it in February accounts because the light bill relates to February. So that's what the accounting period concept is, you know. So the accounting period means everything must be recorded in their period. So whether it be the calendar year, January to December is your accounting year. Everything that related to January to December 2024 must be in 2024. And what related to 2025 must be in 2025. Right? And the matching concept. So the matching concept now, basically, and see a lot of these words, they pretty much mean as you see them, you know. That's a lot of the history. I didn't say the historical concept. Well, historical concept mean is based on what you spend, right? So you're not going to plan on future stuff and be putting future money inside the account, but it's based on what you spend, what you incur already in the past. The matching concept pretty much is what the matching concept requires now is that the revenue for a year must be matched with the expense for that year. What we mean by that? If you sold 5 candies in January, the cost of the 5 candies have to be in January as well. That's what I mean, match it. So you make money in a month, all right, match the money that you spend for that thing in the same month. That's what the matching concept really is, right? So you make some money in a month, then match what you spend for in that particular month. And then the accrual concept, I didn't use a concept with you before, but this is what it means, is that even if you didn't receive a bill, and I mentioned the light bill, the example is there as well, you know that you use the office and you use the AC and you use the light for January, but you didn't receive it. The mailman bring the bill the 5th of February, right? You have to accrue or account for the January bill in January, even though you received it in February, even though you actually paid it in February, but you know it relates to that period. So the accrual concept pretty much is saying that if something relates to a particular period, then make sure you account for it in that period, right? So if something relates to a particular period, make sure you account for it in that period. So you see people saying they operate on a cash basis. Cash basis mean that you're not business about you don't care about when it's incurred. When you pay the money and you receive the money, that's when you account for it. But that's American accounting. Most of the accounting is accruals accounting, meaning you know that you owe the money. So even though you don't pay it yet, put it in your books, right? Account for it and show that you owe it, right? So that's what the accrual basis is, right? That you account for it. You know you owe it, so you're going to account for it even though you don't pay it yet, right? But there are some countries and some jurisdictions where use a cash basis where they don't record anything until they pay for it or they receive the money, right? That's what that. Now we know the accounting equation. We were introduced to the accounting equation, assets, liability. Were introduced to the balance sheet. What I didn't introduce you to, I just mentioned it and I asked you to watch the video, is debits and credits. Okay? But a very simple diagram we're going to use now. Debits and credits. All right? The left side is called the debit side and the right side is called the credit side, right? The left side is called the debit side and the right side is called the credit side. Now, assets. When do you debit assets? When it increases. All right? When do you debit assets? When it increases. When do you credit assets when it decreases, right? So what goes on the left side for an asset is when it's going up. So you buy an asset, right? You put it on the left side. You sold an asset, you get rid of the asset, right? Or it depreciate and it goes on the right side. How about your liabilities? I'm giving some basic to show what goes on the right and the left. And we can reinforce that inshallah. So liability. Liability is opposite. If you borrow some money and that means you have more, you owe more money, to increase what you owe, it goes on the credit side, the right side of the account, right? But if you pay it off, that means it decrease because you don't owe this man this amount of money again, then it goes on the debit side. That's the left side. And the third one, your capital or your equity is works just like a liability. The owner put money in the business, you owe the owner, you know. So it's going to go on the credit side, the right side of the account. And the owner draws some money out of the business, right? Then it's going to go on the left side, the debit side of the account. Now, some people would say, and the reason I ask you all to watch those videos, and there's another I'll ask you to look at as well. People say, oh, you know what, go on with side. That's too confusing. Now, this guy, there's a beautiful concept known as dealer, right? So what is this dealer? D-E-A-L-E-R, right? Then you spell out the word dealer, and let me just do it right here. Let me just do it right here. So let's do something right here. Text. So that's revenue, that's expense, and it shows what your debit and what your credit. When revenue increase, your credit. When expense increase, your debit. So how am I going to go through all of this to know this thing about basic accounting? Now, this is a hack that I can tell you, even accountants, a lot of accountants don't understand debit and credit well. So yes, and you might be surprised that when they study accounting, they did debit and credits in high school. They never did debit and credits again. And now that they end up have to do debit and credits, they are confused because guess what? They are using accounting system and software. And once they put in the transaction, all the debits and credits happen on their own. So they don't really, a lot of them don't fully understand how the debits and the credits work, unfortunately. But let me give you, and this is a hack that was shown in the video, and as I said, I recommend y'all watch that video as well. The hack is this: dealer, D-E-A-L-E-R. Now, what does dealer stand for? I'm gonna basically spell it out. Just put it in a smaller font so we can not be distracted by the first. Dealer, the D stands for drawings. The E stands for the first E stands for expense. The A stands for asset. The L, liability. The other E stands for equity. And I put in bracket the same thing that we call capital. And the R stands for revenue. You know the same thing that we call sales or income. That is the revenue. So let me just expand this so you can see the D-E-A-L-E-R much better. Look at that. D-E-A-L-E-R. Look at the trick now. Now remember, look on this account. When we look on this account, we see the debit side is the left side of the account, right? That's the left side. And we see that the credit side is the right side of the account. Look on this, dealer is 6 letters. 6 letters, okay? Now look at the trick on these 6 letters. The first 3 letters, DEA, that will say what it stands for. No. Let me just make it red. Yeah. The first 3 letters, drawings, expense, and assets. They are on the left side of the word, right? They're on the left side. So if drawings increase or expense increase or asset increase, you're going to debit them because they're on the left side if they increase, right? If liability, equity, and revenue increase, then you're going to credit them because they're on the right side. You see, they're on the correct side, right? That's when they increase. But if they decrease, then they go on the other end. So once you remember dealer, then you strike a deal. It's done. It's a done deal. Once you remember dealer, you know debits and credits better than many accountants, right? So there are many persons who they do their degrees. They did accounting in the first, they did debits and credits in the first semester. After that, they never do debits and credits again. And guess what? When they come out, they don't have a clue what debits and credits are. They forget about it. And because they're using accounting software, when they need to do a journal, they are confused and they do stupidness. They do foolishness, right? But so you as somebody who may not be an accountant, once you know dealer, you understand debits and credits. That's the main thing that some people don't understand. Even as I said, even when they become accountants and making a whole lot of money, there's some of them don't understand debits and credits. But that's the way to understand it. And it's done deal. Your drawings, your expense, your assets, if it increase, you debit. What's the debit side? The left side. You debit. And if your liability, your equity and your revenue, if those increase, so I mean if you borrow money, if the owner put money in the business, if you do sales, all of those are credited, right? Those accounts are credited, right? So because what? That increase. And as I said, it goes in the reverse. So for example, your asset go down, then my asset normally on the left side, But the thing gone down, this thing gone on the reverse, because I don't want it to go down. So I have to put it over on the credit side if it reduce, right? And if your liability go down, normally wait, my liability is normally on the other side, But because it reducing now, I have to put it over the other side, right? So that basically, if you understand dealer, that's why I said sharing these videos on this website, on the YouTube channel, that once you understand dealer, you're good to go with debits and credits. You're halfway there with debits and credits. All you really need after is practice. That's all you need, right? So all you're pretty much going to need is practice, right? So as you said, the left side of the T account is called the debit side. The right side is called the credit side, right? And normally, so yes, the name that you normally give to an account is what you call basically a title, right? So an account title. So if you're naming an account, that is pretty much the title of the account, right? So we know we got the definition of what accounting is, as we said, analyzing your information, recording, classifying, summarizing, reporting. So we did that basically, what accounting is. So for example, if your cash increases, your cash is an asset, then you're going to debit it, right? If your liability increase, meaning that your bank loan, you have to take a bank loan, what you're going to do with the liability, you're going to credit it. If you have your sales, it says revenue, and look on which side it's on. It's on the credit side, right? So those are some of the things that we have to pay attention to. One of the things is that when you see that people list out all of the information, they normally call it their chart of accounts. So a list of all the accounts is normally called the chart of accounts. And where you analyze the information, because it looks like a T, right? Your debit side and your credit side, they normally call that a T account, right? So that pretty much is a little synopsis of, yes, so that's a little synopsis of debits and credits. Now, what I am going to ask you to do, 1 second here. Put something over here. All right, so one thing we are going to do now, very short, 10 multiple choice questions. We're going to do it right now. I want you all to go to joinmyquiz.com. So I know some of you might be on your phone and whatever, the browser might be an issue, but don't worry about it. Once we finish the quiz, then the session will end. So if you can't open another browser, if it's gonna cancel your Zoom, then just open your browser. I know it's Zoom you're using anyway. So joinmyquiz.com. Type that in right now. And you see that code you see on the screen, 498-876. Put that code in and join. It's just 10 multiple choices. It's not going to take you more than 5 or 6 minutes. We'll finish by 7:30, inshallah. But I want this to be a nice little recap for what we just learned from the basics of accounting. So again, I'll just share the channel with you. If you I know y'all should have the channel, but I'll share the YouTube channel with you. That I have both recordings will be on. You can always recap it. And then the videos I sent to you, watch them. They're not lengthy videos, they're short videos. Try to ensure that they're not lengthy. The ones I've chosen, and I believe they're quite clear. Right. I think the guy on this channel, the accounting stuff, I think he is very clear to even non-accountants. So just go on a browser, go on Google or whatever, type in, you know how you're going on a website? The website, joinmyquiz.com, right? You can just put joinmyquiz.com, and then where you have to enter the join code, you enter the join code 498876. So let me give you a little idea here since y'all see the screen. So you type in joinmyquiz.com. No, that's not joinmyquiz.com. Right, my spelling is wrong here. Yeah, let me just remove that P from there. Oh no, hold on, hold on. All right, so let's go again. Join myquiz.com. When you type in joinmyquiz.com, that's what it's, so you're gonna see this thing come up. Enter a join code, and you put in the code and click join. Then it's gonna ask you for a name. Just you put in a name, whether a nickname, your actual name, whatever you want to put in, and then you're able to come in. Right? So you enter the join code. The join code 498876. So I'll show you, I'm showing you right now. So 498876. So you're gonna just type in 498876, join, you put in, you see your name come up, you want to change it, whatever, then you click start, and then you will go in. 10 questions based on everything I said, so don't worry about it. Right, so I'll just give you a couple more seconds to try joining. So joinmyquiz.com, just click on it, just try type that in, and then the number you're gonna type in is 498876. Right? Once you type that in, you're in. So now you see Sulaiman, Harun, and Kadim is actually there already. So all I need to do is click start, and then you're gonna see the questions come up, and then you're gonna choose the correct answer. Right? So you're gonna just choose. All right. So even if after I start, you can actually join, but I don't want necessarily to join. Since we don't have much, you're not gonna spend much time on the quiz. It won't take 5 minutes. As I say, it's 10 multiple choice questions. Very short, very basic questions. So I will start now, in the interest of time. And then see the screen. So you'll notice that even if you didn't join yet, you can see, it says joinmyquiz.com, and the code that would need to enter is 498876. All right. So it says accounting is referred to as. You see that question. Some of you, as you say, your questions are maybe randomized. What's the left side call? What's the right side call? So as long as you know your right and your left, so you have to be careful between your right and your left, because we said dealer and we know what we say happen over those sides. So let's see. Uh, all you got the name given to an account, the account title. So everybody got that. So that's wonderful. What are assets? Everybody answered that question. So what are assets? Right. So basically, right. So anything, any item or property owned by the business, anything owned, not just cash alone. So maybe you might get a little trick there, but anything that the business owns. And we spoke about the whole thing about classifying and stuff. But yeah, that one was a little drop in there. How an accountant record increase in their cash? Okay, the question is, what is cash? Is it drawings? Is it expense? Is it asset? Or is it liability, equity, or revenue? Right. So those are some of the little bit of things that it's just a recap. So don't worry, it's not a graded assessment. It's really just a recap. So nothing to worry about. You just focus on what you think you remember. All right. So we give you at least y'all another 2 minutes to try and wrap it up, and then inshallah we will end our session after that. So you're free to do what you wish to do after now. So instead of making you have to get up back again at 7:30, I think this is probably better. So you can cover what you need to cover, and you decide to do the other activity later this morning, then you are able to, inshallah. All right, so one more minute, and then we will wrap it up. So 10 questions, one more minute, and then we will wrap it up. What is good? If you notice what you see in this tracker here, it's showing overall all three of you got 81% pretty much accurate overall. So the overall average, and you see it's growing there at 82% until you end. So I give you all another minute to wrap it up, and think two of you are finished. So one more minute to make sure all three is finished. Then we will end our session, inshallah. So again, this session is available on my YouTube channel, but yeah, I will share the link so it's easy for you to access. So both session one is there, and then session two is being recorded live. So as soon as the session ends, it will be there available as well. It's available there as well. All right, so we got one more question left. 30 seconds or less. Let's end this. All right, so I think that is it for the questions. That's it for the quiz. Right, and then now what you will see that all of you have completed the questions. 87% accuracy. Then of course the whole fanciness. So yes, it's good when it's just three. So you have first, second, third, right? I don't know if you consider third as third or yeah. All right, so that's pretty much it. So that's it for our session. It gives you an idea of the accuracy levels. So that's wonderful. That's very good. Alhamdulillah. So that's pretty much our little recap for our session today. So again, the videos will be available. Um, it's the same YouTube channel, but I'll just share the link to the channel so that it's easy for us to access. And then, inshallah, on the weekend, we will be going through our live sessions and actually doing some more practice on the basics of accounting. But there's one or two more videos I will share with you that y'all can watch to strengthen the whole dealer concept. So on the, it's the same channel I'm sharing it from, the whole dealer concept and even some worked examples of dealer getting the debits and the credits right. Once you get that right, as I tell you, that is the foundation of accounting. If you're solid on that, you can have any conversation with any accountant, right? So that's it pretty much, inshallah. So may Allah reward you all. Shukran jazilan. Assalamu alaikum wa rahmatullahi wa barakatuh.